Welcome! In this analysis, we are going to deconstruct the very popular YieldMax series of exchange-traded funds. We will carefully examine their structure, their actual performance, and ultimately whether they have a place in a prudent long-term investment portfolio. The investment world has certainly been captivated by the promise of these extraordinary yields, with some advertised annual figures soaring well past 100%. It is really no surprise they've caught the attention of so many investors who are focused on generating income.
And this leads us to the central question we are here to investigate. Are these remarkable distributions genuine earnings from a successful strategy, or do they perhaps conceal a much more complex and potentially damaging financial mechanism? Let's find out together. To begin, let's examine the powerful appeal of YieldMax ETFs. We need to understand the specific strategy they employ to generate such high levels of monthly income. The strategy is designed to generate income by selling options on popular, volatile stocks like Tesla or Nvidia. In essence, the fund collects cash premiums by selling the right for another party to purchase the stock at a predetermined price. On the surface, this approach looks like an ideal solution for anyone seeking high monthly cash flow. Now it is time to peel back the layers on these impressive yields. As we delve deeper, we begin to uncover what this analysis suggests is a critical structural flaw in the design of these funds. The analysis indicates that these high payouts are frequently not generated from sustainable earnings at all. Instead, they are often classified as a return of capital, which means the fund is simply handing you back a piece of your own money and labeling it as income. The Tesla-linked ETF, known as TSLY, provides a very stark illustration of this. While it advertised a yield approaching 59%, its share price plummeted by nearly 50% in a single year. The loss of capital essentially wiped out any income that was received. This mechanism results in a continuously shrinking investment. You are, in effect, systematically liquidating your own asset base to create a cash flow. This directly undermines the foundational goal of preserving and hopefully growing your wealth over time. Next, we must analyze the asymmetric risk profile. This refers to the skewed relationship between potential gains and potential losses that is inherent to the strategy these funds employ. This structure creates a fundamentally lopsided risk-to-reward proposition. If the underlying stock experiences a major rally, your gains are capped at the relatively small premium you collected. However, if that same stock plummets, you bear almost the entire loss. This structure is characterized less as a prudent investment strategy and more as a speculative venture. As the quote suggests, it's akin to gambling with skewed odds, where the investor is poorly positioned to benefit from any significant market movements, up or down. This brings us to a critical finding from the analysis. Not a single YieldMax ETF has successfully outperformed the total return of its underlying stock. Despite the high income distributions, when you factor in the share price decline, the total return consistently trails what you would have earned by simply owning the stock itself. Beyond these strategic flaws, we also have to account for the direct costs that will inevitably erode an investor's net returns. First, these funds carry a high expense ratio of nearly 1%. Now, to put that number into perspective, that is more than 30 times the fee of many common S&P 500 index funds. This fee is charged every year and directly reduces your returns, regardless of the fund's performance. Furthermore, the distributions you receive are typically taxed as ordinary income. This subjects them to federal tax rates as high as 37%. This creates a significant tax drag, as it's a much less favorable rate than the preferential treatment given to qualified dividends from most standard stock investments. So let's bring all of these findings together to formulate a final verdict on where these ETFs might fit, if at all, within a long-term investment portfolio. The case against including YieldMax products in a long-term strategy can be summarized by these four core criticisms: relentless principal erosion, consistent underperformance, a highly asymmetric risk profile, and significant costs from both fees and taxes. Ultimately, the conclusion of this analysis is that the inherent volatility and flawed structure of these ETFs make them unsuitable for the goal of building sustainable wealth. They violate the foundational principles of sound portfolio management, such as diversification, stability, and the incredible power of compounding. This entire analysis leaves us with a final and, I think, provocative question.
For you, the long-term investor, what is the true definition of yield? Is it simply a high monthly payout, or is it a sustainable income stream that actually preserves and grows your capital over the long run? Thank you for your time. If you found this analysis helpful, we would appreciate it if you would press the like button and subscribe to our channel, Finbot Insights, for more deep dives like this one.